Hello and welcome to Storage Trader. Our online platform is the first one built exclusively for investment in self-storage facilities. This YouTube channel shares educational information about self-storage investing designed for both owners looking to raise capital and investors looking to place capital. Before we dive in, make sure to subscribe so you don't miss more videos like this. If you find this information helpful, don't forget to hit that thumbs up button. This segment is titled Qualifications and Significance. In the world of finance, the term accredited investor holds significant weight. It's a label bestowed upon individuals or entities that meet specific financial criteria, granting them access to certain investment opportunities that are generally unavailable to the general public. The concept of accredited investors plays a crucial role in regulating access to high-risk and potentially lucrative investment opportunities, balancing investor protection with the promotion of capital formation. So, what exactly constitutes an accredited investor, and how does one qualify for this status? An accredited investor is defined by the Securities and Exchange Commission, SEC, in the United States as an individual or entity that meets certain income or net worth thresholds. These thresholds are designed to indicate a level of financial sophistication and capability to bear the risks associated with certain types of investments. By meeting these criteria, accredited investors gain access to investment opportunities that are typically not available to the general public, such as private placements, hedge funds, and venture capital investments. One of the primary qualifications for individual accredited investors is based on income. To qualify, an individual must have earned income exceeding $200,000 in each of the two most recent years, or $300,000 combined income with a spouse, and reasonably expect the same level of income in the current year. Alternatively, an individual can qualify as an accredited investor if their net worth exceeds $1 million, either individually or jointly with a spouse, excluding the value of their primary residence. These income and net worth thresholds serve as indicators of financial stability and the ability to withstand potential losses associated with high-risk investments. The rationale behind these requirements is to ensure that individuals who participate in such investments have the financial means to bear the risks and potentially suffer losses without significant adverse effects on their overall financial well-being. Entities can also qualify as accredited investors under certain conditions. Certain types of organizations, such as banks, insurance companies, and registered investment companies, automatically meet the criteria. Additionally, corporations, partnerships, and other entities with assets exceeding $5 million can qualify as accredited investors. Moreover, entities in which all of the equity owners are accredited investors themselves also meet the accreditation standards. The designation of accredited investor status carries significant implications for both investors and issuers. For investors, being accredited opens doors to a broader range of investment opportunities that may offer higher potential returns compared to traditional investments available to the general public. Access to private placements, hedge funds, and venture capital investments can provide diversification benefits and opportunities for wealth accumulation beyond what is achievable through conventional investment avenues. On the other hand, for issuers of securities, having the ability to offer investments exclusively to accredited investors can streamline the fundraising process and reduce regulatory burdens. Securities offerings that are limited to accredited investors are subject to fewer regulatory requirements compared to offerings made to the general public. This can result in cost savings and a more efficient capital-raising process for companies seeking funding for their growth and expansion initiatives. It's important to recognize that the accredited investor designation is not a guarantee of investment success. While accredited investors may have access to a wider array of investment opportunities, they are still exposed to risks inherent in the market. Investments in private placements, hedge funds, and venture capital can be highly speculative and may result in substantial losses. Therefore, it's crucial for accredited investors to conduct thorough due diligence and consult with financial professionals before making investment decisions. The criteria for accredited investor status have been subject to scrutiny and debate. Critics argue that the current thresholds based on income and net worth may not adequately measure an individual's financial sophistication or ability to assess investment risks. As a result, there have been calls for revisiting and potentially revising the accreditation standards to ensure that they align more closely with investors' actual capabilities and risk tolerance. In recent years, there have been developments aimed at expanding access to investment opportunities beyond accredited investors. For example, the Jumpstart Our Business Startups Jobs Act, enacted in 2012, introduced provisions such as Regulation A+ and Regulation Crowdfunding, which allow companies to raise capital from non-accredited investors under certain conditions. These regulatory changes aim to democratize access to investment opportunities while still maintaining investor protections. In conclusion, the designation of accredited investor carries significant implications for both investors and issuers in the realm of finance. By meeting specific income or net worth thresholds, accredited investors gain access to a broader range of investment opportunities, while issuers benefit from streamlined fundraising processes and reduced regulatory burdens. However, it's essential for accredited investors to approach these opportunities with caution and diligence, as high-risk investments can lead to significant losses. As regulatory frameworks continue to evolve, it's crucial to strike a balance between promoting capital formation and protecting investors' interests in the ever-changing landscape of finance. Be sure to listen to the following disclaimer. Storage Trader LLC is not a registered broker-dealer, investment advisor, or crowdfunding portal. None of the information contained in this recording is a recommendation to invest in any securities. Investing involves risk, and you should not enter into any transaction unless you have fully understood all risks and have independently determined that such transactions are appropriate for you. The information provided here is without regard to any particular user's investment objectives or financial situation. Please consult with your legal and financial advisors before investing, and do not invest unless you are able to sustain the risk of loss of your entire investment. Any financial projections provided in this recording, including without limitation expected IRR, are forward-looking statements and may not reflect actual future performance. Investment in any opportunities presented on this website are for accredited investors only as such term is defined by Rule 501 of Regulation D, promulgated under the Securities Act of 1933. The general information provided on this recording is not an offer to buy or sell, or the solicitation of an offer to buy or sell any security, and potential investors will be provided with a confidential offering memorandum prior to being offered a security. We hope you enjoyed this installment of Storage Trader's audio blog. Additional episodes may be found at storagetrader.com on our news page. Select Read More for the article you want to listen to, then click the Listen Now button. Or you can subscribe to our YouTube channel using @StorageTrader. The end.